Investing in the stock market can be a powerful way to grow your wealth over the long term. It offers the potential for much higher returns than traditional savings accounts or bonds. However, investing in stocks also comes with risks. It's important to understand these risks and develop a sound investment strategy. Many people view the stock market as a get-rich-quick scheme. This is a misconception that can lead to poor decision-making and financial losses. Successful stock investing requires patience, discipline, and a long-term perspective. When you invest in stocks, you are buying a share of ownership in a company. As a shareholder, you participate in the company's profits and growth. Over time, as companies grow and become more profitable, their stock prices tend to rise. This appreciation in stock value is one of the primary ways investors build wealth in the stock market. While stock prices can fluctuate in the short term, history has shown that the stock market tends to trend upwards over the long term. This upward trend is driven by factors such as economic growth, innovation, and population growth. By investing in stocks, you are essentially betting on the continued progress and prosperity of the economy. When you buy a stock, you are buying a small piece of ownership in a company. You become a shareholder. Being a shareholder comes with certain rights and benefits. These may include voting rights on company matters and receiving dividends. Dividends are a portion of a company's profits that are distributed to shareholders. They can provide a steady stream of income for investors. The beauty of stock ownership is that you participate in the growth and success of the companies you invest in. As a company expands its operations, develops new products or services, or increases its market share, its profits tend to rise. This growth in profits is reflected in the company's stock price, which benefits shareholders. Moreover, stock ownership offers the potential for compounding returns. Compounding is the process of earning returns on your initial investment, as well as on any accumulated earnings. Over time, even small amounts of money can grow significantly through the power of compounding. Imagine you invest $1,000 in a stock that earns an average annual return of 10%. After the first year, your investment would grow to $1,100. In the second year, you would earn a 10% return on $1,100, not just your initial $1,000 investment. This compounding effect continues year after year, leading to exponential growth over the long term. Investing in stocks is not without its risks. Stock prices can be volatile, and there is always the possibility of losing money. However, by understanding the concept of stock ownership and the potential rewards it offers, you can make more informed investment decisions. The stock market is a dynamic environment that is constantly fluctuating. It is characterized by periods of rising prices known as bull markets and periods of declining prices known as bear markets. Understanding these market cycles is essential for investors to make informed decisions. A bull market is characterized by optimism, investor confidence, and rising stock prices. During a bull market, investors are more willing to take risks, and companies are more likely to invest and expand. Bull markets can last for several years, and they often lead to significant gains for investors. One recent example of a bull market was the period from 2009 to 2020. Following the global financial crisis of 2008, the stock market experienced a remarkable recovery, with the S&P 500 index more than tripling in value. This bull market was fueled by factors such as low interest rates, quantitative easing measures by central banks, and a rebounding global economy. In contrast to a bull market, a bear market is characterized by pessimism, fear, and falling stock prices. During a bear market, investors tend to be more risk-averse, and companies may cut back on investments and hiring. Bear markets can be painful for investors, but they are a natural part of the market cycle. The most recent bear market occurred in early 2020, triggered by the COVID-19 pandemic. The S&P 500 index plunged by over 30% in a matter of weeks as the pandemic spread globally and governments implemented lockdowns. However, this bear market was relatively short-lived, and the stock market quickly rebounded as investors regained confidence. So what is the key to stock investing? Patience and perspective in stock investing. One of the most important things for stock investors to remember is that investing is a long-term game. It's not about trying to get rich quick. It's about building wealth gradually over time. Stock prices can fluctuate significantly in the short term, and it's easy to get caught up in the day-to-day movements of the market. However, it's crucial to maintain a long-term perspective and not panic sell when the market takes a downturn. Remember that the stock market has always recovered from previous downturns, and there's no reason to believe it won't continue to do so in the future. Patience is a virtue in stock investing, It's essential to be patient and ride out the market's ups and downs. By staying focused on your long-term goals and not reacting emotionally to short-term market fluctuations, you are more likely to achieve financial success. Where do we go from here? As of 2025, the stock market is facing a unique set of challenges and opportunities. The global economy is still recovering from the impact of the COVID-19 pandemic. Inflation remains a concern in many parts of the world. The ongoing war in Ukraine is adding to geopolitical uncertainty. Despite these challenges, there are also reasons for optimism. Corporate earnings growth remains healthy, particularly in the technology and healthcare sectors. Interest rates, while rising, are still relatively low by historical standards. Technological advancements continue to drive innovation and create new investment opportunities. Expert opinions on the future direction of the stock market are mixed. Some analysts believe that the market is due for a correction after years of strong gains. Others are more optimistic, citing the strong fundamentals of the U.S. economy. Given the current landscape, it's more important than ever for investors to be selective in their stock picks. Focus on companies with strong balance sheets, solid earnings growth, and a competitive advantage in their respective industries. You must be asking yourself, how do I build a resilient portfolio, and what is diversification? Diversification is a risk management strategy that involves spreading your investments across a variety of asset classes, such as stocks, bonds, and real estate. It also means investing in a range of industries and geographic regions. By diversifying your portfolio, you reduce the impact that any single investment can have on your overall returns. One popular diversification strategy for beginners is dollar-cost averaging. This technique involves investing a fixed amount of money in a particular investment at regular intervals, regardless of the price. By investing consistently over time, you buy more shares when prices are low and fewer shares when prices are high. This can help to reduce your average cost per share and potentially enhance your long-term returns. Dollar-cost averaging is a disciplined approach to investing that can be beneficial for investors of all levels of experience. It's a particularly effective strategy during times of market volatility, as it helps to take the emotion out of investing. In conclusion, the stock market can be a powerful engine for wealth creation over the long term. By understanding the principles of stock ownership, embracing a long-term perspective, and employing sound investment strategies such as diversification and dollar-cost averaging, investors can increase their chances of success. While the future of the stock market is uncertain, history has shown that patience and a focus on fundamentals often lead to favorable outcomes. If you found this video helpful, don't forget to like, comment, and subscribe for more content on investing, crypto, and wealth management. Stay tuned for future videos where we dive deeper into these topics to help you make informed financial decisions. Thanks for watching, and I'll see you in the next one.